Welcome in, everyone. Today we're diving into focus investing. We'll be using Robert G. Hagstrom's The Warren Buffett Portfolio to guide us.
Great book. Hagstrom really gets into how some legendary investors made their fortunes and how they kind of went against the grain to do it.
Right. We always hear diversify, diversify. But what if the real key is finding a few really exceptional companies and sticking with them? That's what this book seems to argue.
It's a really intriguing idea, and to grasp it, I think we have to understand why the usual strategies like active and index investing might not always cut it.
Okay, so let's break those down. What are the drawbacks?
Well, with active investing, you're paying someone to pick stocks, hoping they're consistently beating the market.
Which is, let's be honest, a big ask.
It's a huge ask. A lot of research shows that it's really hard for those actively managed funds to beat their benchmarks, like the S&P 500, after you take fees into account.
So you're paying extra for performance that you might not even get.
Exactly. Then there's index investing. It's more about matching the market, not beating it.
And that's supposed to be less risky, right?
It can be. Index funds are designed to track a particular market index, keeping costs super low and generally avoiding those big losses. But you're basically guaranteeing average returns. You're not going to shoot the lights out.
So if both of those strategies have flaws, what's the alternative?
That's where focus investing comes in. It's active, yeah, but instead of trying to outsmart the market with hundreds of stocks, you concentrate on, say, 10 or 20 companies that you have really high conviction in.
High conviction, meaning you're not just picking companies you think will do well, but companies you'd bet the farm on.
Pretty much. And it's not just some wacky theory. Look at Warren Buffett, Charlie Munger, Bill Ruane. These guys all use some form of focus investing, and their track records speak for themselves.
It's funny, they all seem to have this thing about not following the crowd.
And what's wild is there's actual research backing them up. Hagstrom, the author, along with Joan Lamtenant, did an analysis of over 3,000 portfolios. What they found was pretty amazing. When a portfolio had fewer stocks, the chances of it outperforming the market actually went up.
Hold on, so portfolios with fewer stocks did better. That's kind of the opposite of what you'd expect, isn't it? Why is that?
That's the million-dollar question. The book digs into a few reasons for this. One idea is that when you're focused on just a handful of companies, you can really dedicate the time to understanding them inside and out. That deeper knowledge could mean you make smarter choices, and that leads to better results.
It's like anything else, right? If you're spread too thin, you can't give anything your full attention. But if you only have a few things to focus on, you can really, become an expert on those things.
Absolutely. You're not just skimming the surface. You're digging into the financials, understanding the competitive landscape, really getting to know the management team. That depth of knowledge can be a real advantage for focus investors.
It's not about owning less. It's about knowing more about what you own.
Exactly. And, another really interesting thing about focus investing is that it kind of turns the traditional view of risk and performance on its head.
How so? How do focus investors measure those things differently?
Well, a lot of investors, especially when they're starting out, get really hung up on those day-to-day stock price swings.
Oh, yeah.
They see volatility as the big scary monster. Price dips a little, they panic. Price goes up, they think they're Warren Buffett.
I've been there, checking my portfolio every 5 minutes, riding that emotional roller coaster.
It's so easy to fall into that trap. But that short-term thinking can lead to impulsive decisions that aren't really based on the true value of a company. Focus investing takes a different approach, more like what Buffett always says: be fearful when others are greedy, and greedy when others are fearful.
So don't get caught up in the hype or the panic.
Right. Instead of getting distracted by all the noise of the market, focus investors are trying to understand how the business actually works at its core.
Okay, so what should we be looking at instead of those stock tickers? What makes a company a good investment from a focus investing standpoint?
People like Buffett, these really successful focus investors, they tend to zero in on a few key things. First, they're looking for companies with something called a durable competitive advantage, meaning something that makes them stand out, makes it hard for other companies to compete with them.
So something that makes them special, like what's their unique thing?
Exactly. They also want to see strong financials, companies that are consistently making money, managing their debt well, having a good return on equity.
So these are companies that are built to last, that can ride out the tough times and keep growing.
Right on. And of course, the management team is crucial. Focus investors want to see leaders who know what they're doing, who are looking out for the shareholders, who have a vision for the future of the company.
It almost sounds like focus investing is just as much about psychology as it is about crunching numbers. being able to tune out the noise and stick to your guns, even when the market is going crazy.
You're absolutely right. Managing your emotions is a huge part of it.
So how can investors do that? How can they avoid making those knee-jerk reactions based on fear or getting too greedy? How can they stay focused on the things that really matter, even when the market is volatile? So how can investors do that? How can they avoid making those knee-jerk reactions based on fear or getting too greedy? How can they stay focused on the things that really matter, even when the market is volatile?
That's where a few key principles come in. One of them is understanding probability and really embracing it.
Probability. Like, we need to brush up on our stats skills.
Kind of, yeah. It's about thinking like a poker player, you know? Before you bet, you got to figure out the odds. Focus investors, they're doing the same thing, trying to assess the likelihood of different outcomes.
Right, because there are no guarantees in the market.
Exactly. No sure things. It's more about finding those situations where the potential reward is big enough to justify the risk you're taking. And Buffett himself, he's always comparing investing to poker, knowing when to hold 'em, when to fold 'em.
Speaking of betting, earlier you mentioned this Kelly optimization model.
Yeah.
How does that fit into all of this?
Yeah, the Kelly criterion, as it's sometimes called, is basically a formula that helps you figure out how much to bet based on your chance of winning. It's a pretty complex idea, not something you can just plug and play in the real world. But what it tells us is conviction is key. The more confident you are in an investment based on solid research, of course, the more of your capital it might make sense to allocate to it.
So diversification is still important, but it's more about concentrating your investments in your absolute best ideas.
Exactly. It's not about putting all your eggs in one basket, but it's also not about spreading yourself so thin that you never really get ahead.
Finding that sweet spot between conviction and being sensible. But even when you've done your homework and you're feeling good about your picks, the market can still throw you curveballs.
Mm.
How do you handle that as a focused investor? How do you ride out those ups and downs?
Patience. That's the name of the game. This isn't about getting rich quick. It's about taking the long view, weathering the storms, and trusting that in the long run, the really great companies will prove their worth.
Which, let's face it, is easier said than done sometimes.
Oh, for sure. It takes a certain kind of personality, you know? You got to stay calm when everyone else is freaking out. Can't panic and sell every time the market dips. Imagine a ship captain in a storm.
They don't jump overboard the first sign of trouble.
Exactly. They use their training, their experience, their compass to navigate through it.
So focus investors need their own internal compass, those guiding principles to keep them on track.
Absolutely. And those principles, they come from a deep understanding of the businesses you own, not from following the whims of the market. And that brings us back to the idea of building a personal economic benchmark, as Hagstrom calls it.
Right. We touched on that earlier. Can you unpack that a little bit? What does that mean, and why is it so important for focus investors?
So instead of obsessing over every little price fluctuation, focus investors should be laser focused on how their businesses are actually performing. Things like look-through earnings, which basically means looking at your share of the profits those companies are generating. Return on equity is another big one. How efficiently are they using their assets to make money?
So it's about tuning out the noise of the stock market and tuning into the real heartbeat of the business.
You got it. By focusing on those internal metrics, instead of all that external noise, focus investors can make more rational decisions. They're less likely to get thrown off course by their emotions.
Sounds like focus investing is more of a journey than a destination. You're always learning, adapting, getting better at it as you go.
Couldn't have said it better myself.
Yeah.
It's a lifelong pursuit, really. Requires discipline, patience, and a healthy dose of, hey, maybe the crowd's got it wrong.
Well, this deep dive has given me a lot to think about, that's for sure. We've covered a ton. The limitations of those traditional investing approaches, the core ideas behind focus investing, and of course, the mental game it takes to be successful. As we wrap up here, what's the one thing you hope listeners take away from all of this?
You know, focus investing, it's not for the faint of heart. You got to be comfortable thinking differently, maybe going against the current a little bit. But for those who are patient, who are disciplined, who really get a kick out of understanding how businesses work, it can be a really powerful way to potentially beat the market and reach your financial goals.
It's about cutting through the hype, tuning out all that noise, and zeroing in on the fundamentals that really drive long-term value. It's about being a student of the market, for sure, but also being a true owner of the businesses you choose to invest in.
Beautifully put. It's about taking control of your investments, making decisions based on solid analysis and your own convictions, not fear or speculation.
This has been fantastic. Thanks for joining us for this deep dive into focus investing. We hope you found it valuable and thought-provoking. Until next time, keep those brains engaged, and as always, happy investing.